So markets reacted, didn't have the full picture. We still don't have the full picture about exactly what has happened in Iran, in Syria, and by whom. But the markets are nervous. But we're off earlier lows on stocks, off earlier highs on oil, as if perhaps, you know, we're working our way through this. What's your sense at this point on this story?
Yeah, and I think you're right, Anna. Maybe the knee-jerk reaction that we had in the Asia session when we didn't have all of the details was a little more extreme than what we've got now, where it seems like there's no immediate saber-rattling or escalation on the Iranian side, not huge outrage, and on the flip side, not too much damage caused by whatever these blasts and explosions have been. And so that's enabled the market to unravel some of the extreme risk-off sentiment that had been priced in while still being on edge and setting us up for a risk-off day. I think, you know, the big concern was, is this a strike on military structures in Iran? Is it on the nuclear stuff? It became clear that the damage didn't seem to be anything like as extreme as that, and probably not aimed in that direction either. So as you said, some officials describing it as mild, but enabling the market to cool off a little bit from some of the moves that we'd seen priced in earlier.
Yeah. Where does this leave Treasuries, fixed income markets, Paul? Because there are competing trends, just as we saw at the beginning of the week. It seems the Haven bid is winning out over inflation fears this morning. But where does it leave us?
Yeah, so it's interesting, the Treasury's response. Earlier on, overnight in the US session, there was a little bit of focus on the fact that two of the Fed policy makers actually responded to questions on the possibility of hikes and said that they wouldn't rule it out. All of a sudden, we were thinking, oh boy, are we headed for another Treasury sell-off? But of course, you know, in came the Haven bid, which flipped us on our heads in a way, drove interest rates lower, shows that Treasuries still do have that Haven appeal if you're looking for places to hide out when there's risk. That and gold did well. The yen and the Swiss franc rallied as well. So some Haven assets did perform after all.
Paul, good morning. It's Guy. So we're going to flip back fairly quickly to focusing on that Fed narrative. Williams is out talking about hikes, as you've mentioned. How quickly do we return to that? We have seen a pretty risk-off week, basically. You certainly look at kind of how sessions have developed. You've seen reversals throughout most of the days, and we've been heading lower into the close. Broadly, as we come to the end of the week, how weak is sentiment for risk assets?
Yeah, impossible to completely say without fuller clarity on exactly what happened in the Mideast, Guy, and I wouldn't want to be flippant about that by any means. When we started this week, you know, the question that we had before markets opened on Sunday was what would be the Israel response to the situation, to the Iran bombardment that we saw over the weekend. We got a little bit of an answer to that now, but it's not clear that that's the final answer. And so those tensions remain elevated. Even though during the week, you know, there was also all of this look at the higher U.S. interest rates and what that's doing to currency markets and the dollar as well. Feel like that's not gone away. And in fact, you know, if oil prices continue to have an embedded premium in them, that only talks to the idea of higher inflation still and the need for the Federal Reserve to continue to worry about that inflationary outlook. All the data that we've had has been pointing to the U.S. economy still firing on all cylinders as well. So that's all there in the backdrop. The IMF meetings this week provided a nice canvas for everybody to be discussing it. Now, of course, we're going into this period where we're not going to hear from Fed policymakers for a while as well. So it's only going to keep the market on edge as we build up to the next meeting and the next fuller update into Fed thinking that we'll get from there. But it's really interesting. You look at the pricing in the market. You know, we're basically at zero for the front months in terms of whether the Fed's going to cut or do something else. We only see a full cut being priced in September or maybe November, and only, you know, less than 2 for the entirety of this year. So that talks to that idea that we're going to have that embedded premium in yields, and that's going to continue to support the dollar and drive that kind of nervous sentiment across the rest of the global financial market complex.